General observations: a strong stable uptrend with horizontal ranges, slowly stepping up before the more recent sharper incline. Small gaps are sometimes called common gaps since they are not rare and they are often filled. They usually have influence confined to the very short term unless they are part of a larger pattern, such as a double bottom. In this case, there is minor resistance that is overcome without much delay. A highly influential horizontal range has formed and continues to have a significant impact. So far, there has been a less strict triple top in the short term, within the confines of the range. In the longer term, a strict triple top has been avoided as the lower 70s boundary held. This is turning out to be the probable completion of a failed strict triple top that has a gap up candle proceeding over the 7850 boundary for a likely bullish continuation. Indeed, it is highly bullish context in the short term to move higher, and reveal the horizontal range to be the resting phase in the continuation of the long-term uptrend. Here is a similar situation to the past horizontal range, except in this case there is a noticeable incline as the market crosses over the new upper boundary in the low 90s. Bullish progress certainly stalled with a noticeable flattening of trading in a fairly volatile range, with large fluctuations in the lower to mid 90s where there isn't overly high selling pressure, but it is consistent. It was certainly a characteristic triple top that gradually accelerated to rapidly slip under 9350, which presented a short-term lower boundary to the temporary range. There was generally normal volume in the triple top range, and some instances, especially in mid-June, where there was higher volume to more strongly define the range's outline. It could possibly be called a flat top since there was one candle that spiked up in mid-July to briefly touch the 9560 level. However, it is not so important to count whether there were 3, 4, or even more downswings based on candle wicks and real bodies. The main feature is a horizontal range that ended with increasing bearish sentiment, both in terms of price action and volume. Note the triple top reversal ended in the lower boundary of the previously defined incline, and now sees a narrow upward channel develop on the same approximate trajectory. A broader perspective does point at a potential head and shoulders, with the neckline defined by the lowest uptrend line, the shoulder level defined by the second lowest uptrend line, and the head outlined by the triple top range. Watch the lower trend line closely. In the short term, the chart is neutral to bullish to maintain the upward slope with close to normal levels of volume. Likely a definitive break. A pause with the current bull hammer is normal, since residual support can remain around the key lower boundaries of patterns, such as the neckline of this head and shoulders. It is a price increase, but not a definitive uptrend just yet. Bearish advantage remains in the medium to long term. This is even more bearish price action in the short term to render the last two candles as insignificant volatility or noise within the broader chart context. Another minor upswing pulls some bullish sentiment back to the inclined neckline, but it is short-lived due to even stronger drops and greater increases in red volume. After a neckline is broken, it is normal to see minor bullish retracements to form upswings that can recontact the neckline. As would be expected, major support is found near the mid-70s that were the site of the last two major events on the chart prior to the more recent bearish events. A particularly rapid recovery benefited from an overly sharp decline in early October, along with the clear reversal candles forming with high volume at the important mid to upper 70s support range. The candle price action from October 9th to 17th is also a great demonstration of a sharp transition from a rapid fall to a rapid rise. Strong bearish sentiment remains at the lower 90s range. Some sharp drops are quickly reversed by the continued influence of the inclined neckline, now reversing rolls to offer support that is concentrating around 88.25. Naturally, a trend line would have much less influence after being broken, but since it was part of a channel and later the head and shoulders, it retains much of its influence, similar to trend lines derived from patterns in most cases. A trend line from a pattern will of course retain influence longer if it is on a shallower angle around 45 degrees, such as the inclined neckline that has now been breached around 88.25, to reveal the completion of a double top. The current double top does have some features similar to a head and shoulders. Because of minor swing points before and after the main M outline. This is especially true for the minor downswing that preceded the breach of 88.25. That is less common in the strict M-shaped outlines of double tops. As would be expected, there is supporting influence from the 80s ranges, but more importantly, major long-term support at the mid to upper 70s. There is also a clear demonstration of steeper trend lines from a pattern lasting for a shorter duration than shallower trend lines. This doesn't mean they are worse, it just reveals the sharp trajectory that is less sustainable. In this case, for the bearish reversal that was weakening more definitively from March to April as the steep descending trend lines were surpassed, and gave way to a prolonged horizontal range. That is until more bearish spikes led to the break under 77 towards July. The 77 to 78 range is certainly strong, but it doesn't serve as a full guarantee. No major double or triple bottom took place, and the lower support was eventually breached under the continued downward slope of the shallower downtrend lines. Even if trend lines are from patterns, they still generally retain less influence after being crossed, compared to horizontal levels and ranges that can still diminish in influence but to a lesser degree.